my absolute delight to introduce Martin Wolf, the Associate Editor and Chief Economics Commentator for the Financial Times. He was also a member of the UK's Independent Banking On Commission, and his awards on journalism and writing are a very long list. His most recent book, The Shifts and Shocks, What We've Learned and What We Still Have to Learn from the Financial Crisis, was published last year, and surely must be one of the most insightful and trenchant analyses of the financial crisis. So really, it is just for me to hand over to Martin to hear his presentation. There will be lots of time for questions, so please don't be shy when you've got questions at the end. Let's see you and let's hear them. So Martin, can I hand over to you for you to do your presentation, please?
Yes. Well, apparently you're not going to see my presentation.
Oh.
I've just discovered. So, this is exciting. I haven't prepared for that, but that's all right. I can talk about it, so you'll have to think of it as a virtual presentation.
Very sorry about that. I can still arrange it.
No. Life will be, I've done these things many times, and I know roughly what I was going to say, and I'll make some of it up. So first of all, it's a great pleasure to be here, and I've been informed, which I don't really believe, that some of you have found it difficult to follow the English of some of the speakers. I'm absolutely certain that will not apply to me. I will be trying to be as clear as I can. I've been asked to talk about finance in the context of the Eurozone and the challenges of the Eurozone, and also to make reference to what I wrote in my book, The Shifts and the Shocks, which is an attempt at a comprehensive analysis of what happened to the global economy and the global financial system, and how those two things, they're not two things, how those aspects of our economic system work together to create the huge financial crises of the last 7 years, maybe 8 years more appropriately, nearly 8 years, sometimes referred to as the transatlantic financial crisis. Others refer to it as the global financial crisis. It's interesting to consider where those nomenclatures come from. I think the Americans think of it as just the American financial crisis, and I just think of it as the financial crisis. So, and I wanted to relate that to the particular problems of the Eurozone and some of the lessons that might be drawn from this experience for what I think are the very special features of a functioning financial system for the Eurozone. This is not something I've written about much. It is in my book, but not as clearly as I think now it should have been. And I will explain that now so you've got some idea of where I'm going to end up. It seems to me, and to many others who've looked at what happened in this crisis, that one of the big problems, and I refer here, I think, particularly to work by Adair Turner, Lord Turner, the former head of our Financial Services Authority, that one of the big problems is an extraordinary over-reliance on debt contracts in general and bank-generated debt contracts in particular in managing financial intermediation within our economies. And it is quite clear that in this respect, we can think of it as the leverage ratio for our economies. The amount of debt in our economies can be thought of as the leverage in our economies. Reached levels relative to economic activity before the crisis that had no historical precedent. And there's no real doubt that had a lot to do with what has since gone wrong, and it has had a lot to do with the difficulty we've had in coming out of this crisis, which I would have shown you if you had the charts, but you can't see, but I will talk about them. So one of the big questions that arises, if we think about the future of finance, is whether this extraordinary reliance on traditional debt contracts is a good idea. And if so, whether we could change that in some respects. It's an issue that actually I referred to in my column this morning on the problems of Greece. So the general question is the question of risk sharing. How are risks shared if the world ends up rather different from what people thought it would be when they made the original contracts? That's a really quite fundamental aspect of the financial system. Oh, something exciting is happening. And so one of the things I discuss in my book is a host of American ideas on how you would change the financial structure to have more instruments that have equity-like characteristics. That is to say, not necessarily strict equity, they could be, but that are structured in such a way that in the event of something going wrong, the pain is borne by both the creditors and the debtors automatically, and one avoids in the process debt crises, mass bankruptcy crises, and the problems associated with them. So that's a general characteristic, it seems to me, of the challenge created by this crisis, is whether one can construct a financial sector in which risk sharing, automatic risk sharing, is built in to the contractual form. Now, as I will argue at the end of this, I think that challenge is much more significant for the Eurozone than it is for financial systems in most other monetary systems. And the reason for that is that some of the automatic adjustment mechanisms that are available for managing the untoward events that people hadn't expected, are lacking in the Eurozone. And there are essentially two pretty standard adjustment mechanisms to unexpected shocks in the world economy more broadly, which the Eurozone doesn't have. One is, of course, by definition, exchange rate adjustment. This is a world in which you could assume that this is not always the case. Most transactions are in a domestic currency. There are matched balance sheets in the economy. The assets and liabilities are more or less in the same currency. And if something goes wrong, so people don't want to hold the domestic assets, the currency will adjust downwards, and you won't have the same sort of foreign currency crisis as you will have when this adjustment isn't possible. So that's one adjustment valve that doesn't exist. Within large federal unions, which are common currency areas, take the US, for example, there is a second line of adjustment, which is automatic, which is, of course, fiscal. This is a fiscal union. It's not a particularly generous fiscal union by the standards of developed countries within Europe, for example, or indeed Canada or Australia, but it's a fiscal union. And there's a lot of evidence that the fiscal system bears a great deal of the shock when something goes very seriously wrong. Among other things, the fiscal union backs the entire banking sector, as we saw in the US in the worst years of the crisis, one of the big changes between this crisis and the 30s. But the Eurozone, of course, is an irrevocably fixed currency union, or how irrevocably fixed we might find out in the next 6 months, but let's assume it's irrevocably fixed for the moment. And it lacks all fiscal union. So my argument would be that one of the most important questions that should be asked, and it seems to be not being asked at all, in the debate in Europe, or to an extraordinary small degree, is how far the financial sector is constructed to bear risk if anything goes wrong. And the answer, so far as I can see, is it isn't. An extraordinarily small part of the flow, and particularly the cross-border flow, took the form of equity financing, including foreign direct investment. Nearly all of it was debt contracts. And the debt contracts were basically took two forms, either bank lending, which played an enormous role, or government bond finance. And both of these have the characteristic that if something goes wrong, the values are such that all the burden of its having gone wrong fall on the debtors. And that creates crises, inevitably, and colossal ones. And the reliance on bank funding, as we saw, repeated an experience that anybody like me who spent a lot of time thinking about developing countries is very familiar with, which is that short-term bank funding in a funding of banks, via banks, because it's by its nature, banks are funded short-term, that's what they do, that's what they are, this runs. And it runs cross-border particularly rapidly if the banks decide, or the people who fund the banks decide that the entities they've lent to, being very highly leveraged, which they always are, banks are highly leveraged, are no longer sound. So you have built-in bank-run possibilities. And a big challenge for the Eurozone is to construct a financial system which is less vulnerable to this sort of feature. But I would argue very strongly, I'll come to this at the end, that it's a particularly big challenge to make the Eurozone work in future in the absence of a fiscal union. And I'm going to assume that a true fiscal union of a federal kind will not emerge in the Eurozone. It seems to me as clear as anything that it won't, at least not for the foreseeable future. That the financial sector has to be able to risk share more effectively in the event of untoward circumstances than it has been able to in this crisis. Now, that's sort of the big financial sector point I want to make. And it is, I think, a different way of thinking about the peculiar challenges that the Eurozone faces as a structure. And I think also how radically you might want to think about what a desirable structure for this system should look like. Now, in the presentation, and beyond that, I want to make probably, and I'll come back to this, two fundamental points about my book and its relevance to the thinking about where the Eurozone is, because the issue I've raised is only one of the two main challenges, it seems to me, that the Eurozone now confronts. One is the construction of a financial sector, that is actually capable of of coping with major shocks efficiently without essentially loading up all the costs on the debtors, because I think that the result of that is going to be prolonged debt aversion, very prolonged debt aversion. And if that I'm right about that, I think it will mean that the Eurozone is stuck in chronic long-term demand deficiency. And that's the second big point I want to make. And the first big point I want to make is how this fits in with my core analysis in the book. So I'll just make that, and then I'll talk about this chronic demand deficiency problem and how it links with what I've got to say. So the big point about my book is that, in my view, this huge global crisis, and it includes the Eurozone very much as a core part of this, resulted from some very, very special global macroeconomic conditions in the late 90s and early 2000s, sometimes referred to as the global savings glut, which interacted with our liberalized, innovative financial sector to create an extraordinary credit boom, which seemed to resolve the problems of insufficient demand in the developed world until everything blew up. And since then, we have been unable to resolve those problems, which is why the developed countries have been stuck in a zero interest rate, zero real interest rate, long-term real interest rate, negative short-term real rate world for essentially 6 years, which is a very extraordinary state. So the argument on this is fairly simple. In the late 90s, we had the Asian financial crisis. The Asian financial crisis, in my view, was a decisive global event. Very few people understand how decisive it was, because it was the moment at which the main emerging economies, particularly those in East Asia, with the best investment opportunities in the world, decided, they made the decision, we cannot afford to be open to capital from the developed financial sector, because this just leads us into terrible crises. Therefore, we are going to run our systems on the basis of running very large external surpluses and accumulating gigantic foreign currency reserves to remain a position of being immensely long in reserve currencies, and above all, the reserve currency, the dollar. So the emerging world, which had the best opportunities in the world, became a massive current account surplus region, and China was the most important part of that, and accumulated colossal foreign currency reserves. And at the same time, two other things happened. First, a number of European countries, of which the most important by far was Germany, but it was not the only one, for a whole host of reasons I don't have the time to go into, also moved enormously into current account surplus, that is saving surplus conditions, and wished to export capital to the rest of the world. And finally, we had a huge oil shock, which added to that. And as a result, the aggregate of current account surpluses in the world increased relative to global GDP by about 6 times in a very few years, from 98 onwards. Now, it is clear, as I've been trying to say many times, that the global balance of payments has to add up. So this one did add up, and it added up by other countries obviously running huge deficits, which were fueled by relatively relaxed monetary policies, the monetary policies of the Fed, of course, the monetary policy of the ECB as well. And they worked through credit bubbles. And these credit bubbles were all associated with property, with no exceptions. They mostly worked in what I call peripheral Europe and, of course, the US. And the countries in which those credit bubbles occurred all went into crisis simultaneously in 2007 and 2008. The capital flow in these countries almost ceased, with the exception of the US. As a reserve currency country, it had a unique position in being able to attract capital even though its financial sector is melting down. This really is an extraordinary privilege. It's not true for anybody else. And of course, it wasn't true, above all, for anyone in the Eurozone that got into a crisis. The capital simply stopped flowing. The credit bubble solution to the macro problem stopped. There was a series of sudden stops. In the case of the UK, there was a massive currency adjustment. In other countries, the adjustment occurred through quantity. Capital flowed outwards. The borrowers all got into crisis. The countries got into a crisis. The ECB picked up a lot of the pieces, but by no means all. A whole host of facilities you all know about here better than I do, the FSF, the ESM, were created in order to stabilize the situation. And 7 years later, we are where we are. The crisis, with one exception, which we know very well, has been sort of stopped, but the demand that was being generated by the credit bubble before the crisis disappeared. And as I've pointed out many times, today in the Eurozone, real demand is 5% lower than it was in the first quarter of 2008. So this is basically a continental-sized economy that's gone ex-growth, because there's nowhere in this system generating demand. GDP has not fallen by quite as much as this, and the main reason it didn't is that there's been a very large shift into current account surplus by the Eurozone, so importing demand from the rest of the world, which has cushioned it, but even GDP is still about 2% below the pre-crisis peak. To compare it, the US GDP is now about 8%, 8 or 9% above the pre-crisis peak. So the divergence between the two economies is very, very dramatic. And so the big question to me from a macro point of view is, how does the Eurozone get back to being an economy that generates demand in line with potential supply? And the fact that there is excess potential supply seems to me to be indicated, among other things, by the fact that investment has continued, even at a lower rate, and there's huge unemployment. So this is a major macroeconomic challenge. And it's not clear how this is going to be fixed within the Eurozone. It's not clear how this is going to be fixed, it seems to me, even now. And it's for this reason that we look at the ECB pursuing these completely extraordinary monetary policies, and most of us feel it's not really going to work. They're doing these extraordinary policies, but they're not really going to work. Now, so that's the macro problem. Now, how does this fit into the micro problem? Now, a partial solution for this dilemma is obviously continuation of growth of the external surplus. That essentially, it's what I call turning the Eurozone as a whole into a bigger Germany. I think most of us feel that, and I suspect most of you feel that, that's really not going to work. First of all, most of the economies of the Eurozone are not Germany. They don't have the industrial strength, the ability to export industrial products to the whole world of Germany. And secondly, the Eurozone is 3 times as big as Germany, and growing on that basis implies, well, here's a rough figure. If the Eurozone were to generate, say, 1% a year growth out of a rising current account surplus, the current account surplus would have to rise by 100 billion euros a year. And you have to ask yourself, who's going to be on the other side of that in the rest of the world economy? And the answer to that, by the way, is it's going to be the US. You can see that already. And the Americans are not going to like this. So that doesn't look to me a real solution. It's a small solution. You've already decided in the Eurozone that the governments can't expand demand through fiscal policy. Fiscal contraction has stopped, but fiscal expansion is not going to be permitted. So government spending is out. Mr. Juncker has put forward what you must all recognize is an utterly trivial central Eurozone investments budget. That's not going to change anything either. So it has to be the private sector. By definition, it has to be the private sector, which means private sector investment, because it can't be consumption given the conditions with exception possibly in Northern Europe, and there, because of aging and so forth, it seems very unlikely. It has to be private sector investment. And it has to be private sector investment in economies which have been starved of investment, which means the peripheral economies. And that brings me back to my starting point. A core part of getting the economy to grow again is to have an enormous expansion in private sector investment in the depressed economies of Europe. That clearly requires some structural reform, but it cannot be done on the basis of the sort of financial sector that blew up so comprehensively in 2008. It has to work in a different way, and it comes back to the point I made. A fundamental attribute of the Eurozone as an integrated system has to be a way of getting surpluses from the savings surplus parts of the Eurozone to the savings deficit parts of the Eurozone, the bits which will be naturally importing capital, in a way which doesn't lead to the bank runs and financial collapses that we saw last time. So what I've tried to do, I've got lots of charts in my presentation, you can have them, which explain all this in some detail. It seems to me that thinking about the macroeconomic problem of the Eurozone and the future financial structure of the Eurozone has to go together. And it has to be focused around the question of how could you generate and finance an investment-led boom in the Eurozone, which doesn't blow up in the way that the last one did so comprehensively. And in my view, and we can discuss this now, I'll stop, this problem is not only not been really solved, it hasn't really been addressed in any way, in an integrated way. My concern is that because it hasn't been addressed, the ECB has had to end up with these extraordinary measures which probably won't work. The Eurozone is almost certainly going to have an extremely weak recovery. It's beginning to recover, but incredibly weak. That seems to me will lead large parts of the Eurozone in permanently high unemployment for cyclical reasons. Of course, there are structural problems as well. And in that case, the political problems that we are seeing so clearly now in Greece will emerge elsewhere. I don't think I need to list the problems, and the concern we've had about stability will return. So that's more or less what I wanted to say, and I'm now very happy to discuss this or any related questions that I'm asked about. Thank you.
Well, thank you, Martin. Absolutely wonderful that you can do that without slides as well as without even missing a beat. One of the things that kind of runs through your book, I think, as well, and is here as well, is I remember when I used to read when I was a gold trader and worked in the dark side. I used to read your columns, and what's interesting is as the crisis has unfolded, you've actually become quite a radical voice, which is just amazing. But and I think in your book you talk about the orthodoxy of economics being nonsense now, and so therefore it's time to rethink that. But do we have to, in order to do that, actually change the political structures that are in place? Are the political structures that we have in place actually preserving that orthodoxy that you've talked about as nonsense?
It's very difficult for me, and I'm not sure I'm very good at it, to consider how radical politics have to change to make sensible reforms work. I suppose my starting point, which is maybe considered in some ways rather British, which is it's not very sensible and it's probably not very moral to recommend revolution as a strategy, so I don't. And I wouldn't. I don't. My general view from history is that revolutions always disappoint, and that is perhaps understating it a bit. So I think that we're in the game of incremental reform.
Yep.
Now, so to go back, I don't want to go through the long history. It's evident that the 30s and what happened in the 30s led to a series of economic and political catastrophes, and people learnt from this to create both political and economic regimes, institutional changes during the 30s and after the war, which contained most of those dangers and created, at least for a while, a stable and dynamic economy in which the fruits were widely shared, and many of us would consider a very successful period. Now, I certainly don't think we can go back to that period because the situation has changed in many dramatic ways, including globalization. But essentially, in the last 30 years, running up to the crisis, we operated within what I think called the old orthodoxy, which was essentially that if we had open economies, which I'm still in favor of, and a liberalized financial sector allowed to innovate and develop in the way it was allowed to innovate and develop, and a stability-oriented monetary policy focusing on controlling inflation, the world economy would be reasonably stable, dynamic, and efficient. That was to caricature. That has turned out not to be the case, and I think it would be very foolish. I mean, I've just given you some examples from the Eurozone, but essentially we've suffered an enormous crisis, and all the developed world in different ways is suffering from a lost decade. So it's not a small matter at all. So we have to think about incremental reforms that will shift first get us out of the current mess, and two, shift the way systems work in such a way that will ensure that we will avoid running into them. That seems to me just a pressing need.
Yep.
Now, my job as a commentator in a book like this is to put forward quite radical ideas and to suggest why they make sense. We can discuss some of those ideas if you like. I don't actually expect, since I'm very much a political outsider, that the policymaker is going to run off and say, he's got it right, we'll do what he wants. And I'm not that naive. Maybe naive, but not that naive. But what I hope is that by putting forward these ideas and supporting people who have put forward more radical ideas on the monetary system, the financial system, the operation of fiscal policy, and so forth, I want to recreate the possibility of using fiscal policy. That's pretty clear. I know everybody knows that. That I will make it a little bit easier, just a tiny bit easier, for policymakers to say, well, maybe we can move somewhat in a more radical direction than we thought, because there's actually more pressure from it, even from people who are at least borderline respectable. So I don't want a revolution, don't believe in them, not very likely, no. But I want more than what we've got now. It seems to me that what we are doing, what we have done since the crisis hit in both macro policy and finance, has not been enough either to give us the recovery we need, and that is now creating huge political dangers, or to ensure that we have a system sufficiently robust to cope with the world we now live in without a very high danger of further crises. And that being the case, it seems to me one just has to do the best argument one can for reforms.
Yes, yes. So, I mean, just staying with Europe for a moment, in the book, you know, one of the things that you see as a great moment is when the governments bail out the banks and the money is put into supply, and then, of course, everyone starts banding around the word austerity, and we kind of take a massive step back. And with Greece, we're starting to see a more institutionalised rejection of that austerity. Where does that leave Europe, do you think? Where do you think it goes? Because, I mean, you're absolutely, I think, you know, it'd be difficult to disagree that we're in a kind of bad place. But it's very difficult to see how that will unfold. Because, as you say, would we take it apart? Very unlikely. Will it just consolidate into a political, fiscal and monetary union? Unlikely. Do you think there's an alternative? Or will we just muddle on?
Well, I am obviously very concerned about where Europe finds itself now. You know, there isn't any great secret about this. I'm a pretty typical sort of British trained economist in thinking 25 years ago that, you know, why on earth did they want to create this single currency? It makes absolutely no sense. So, this is a fairly traditional view. So I have that perspective. I have to be completely open about it. But that's irrelevant. It was created. It's there.
Yeah.
Now, the question is, how does a continental-sized currency union, which has a central bank, which is an important insurance provider, we can discuss that. It is an important insurance provider for sure. But otherwise has completely separate fiscal policies and no fiscal union. How does it, and suffers for what I think are quite deep structural reasons to do with aging and so forth, very weak internal demand. How does this union work? How can it be made to work? Now, I'm very concerned, and I've been writing this for years, that the Eurozone was stuck in after the crisis, which stopped all the private sector flows and the support for private sector investment round the periphery, where it had been relatively strong, but of course bubbles. after that stopped, basically private demand collapsed. That first round created huge fiscal deficits, which then have been contracted very, very dramatically. So domestic demand has essentially been completely stagnant. And in that context, potential output is still growing a bit every year, not much, maybe only 1% a year. But that means that the output gap is getting bigger all the time, which I think is the case for the Eurozone as a whole. And deflationary pressure builds in. I don't care about the actual deflation now, that's oil prices. But slowly but surely, price expectations are falling back. Now, there's a big argument about whether that's a danger or not, but it's clear the ECB considers it a huge danger. How do you get out of this? How do you get out of this? Well, one possibility is to say, well, it's not a problem. We are just where we should be, and everybody should be content with this, because that's the best we can do. Make your reforms, it'll all work out. I don't accept that view, but that is obviously one strongly held view. It does assume that there's going to be a more political patience than I fear there will be. The second possibility, as I've said, is to hope that the Eurozone will be floated off by the growth in global demand. Ultimately, the Eurozone will end up with a current account surplus of 7 or 8% of GDP, like Germany, 6 or 7, and the rest of the world will offset this by running a comparable deficit. I think that's a fantasy, but it's one. The third possibility would be to change the fiscal rules. That seems to be impossible, couldn't be financed properly anyway. And then you've got the central bank, which is essentially trying to promote a private sector boom. That's essentially what this is all about, a mixture of the currency decline and the private sector boom. And I think that's going to be very, very difficult to do, given that yields are already so incredibly low. The idea that QE will transform the situation is not very plausible. And to the extent it will work on the external value. And the Eurozone is too big to become an export-led growth economy, I think. So if I were asked how you get out of this in a way, I'm not going to say that 10 years from now everything won't be booming. It might be. But how you get out of it in the next few years, I just don't see it. I don't see how that's going to happen. And if that's the case, then the political pressure is going to grow. Now, it won't grow in Northern Europe because people are reasonably okay, but in Southern Europe it's going to grow. And then I think the dangers are obvious. So I'm fortunately in this case much better at diagnosing, I think, the problem than seeing any feasible ways out. I'm glad the ECB is doing what it's doing because it's all it's got. It seems to me clearly too late. It's always too late because it needs the political coverage for it. But we have to be realistic. The effectiveness of a central bank in this context in generating additional demand and then inflation and so forth is going to be, I think, quite limited.
Yeah. And if it's as you say created by the current account surplus, it's putting off a problem that could come back anyway.
Yeah, I mean that part is not going to, I think, be a sustainable solution. One of the points I made in my book is that if you look at global economy in the run-up to the crisis, the US consumer played an incredibly large role in driving demand. The US consumer is coming back a little now, but it's not going to do the same thing again. The US still has a lot more debt than it did in the early 2000s, and the financial sector will not be allowed to go as crazy as it did last time. So while the US may generate a larger current account deficit, it will help a little, it's not going to be enough to float off the rest of the world. So I think the reforms you have to look for are some combination, as I said, of transformation incentives for investment in the private sector and transformation in the financial sector that finances this in a stable and sustainable way in which risk sharing is important. So one of the things I really would have liked to see is a massive increase in the role of equity, but also other contracts. For instance, I mean, doesn't solve this problem, but I actually think the Greek proposal for GDP-linked bonds makes particular sense within the Eurozone context because it's one way for creating risk-bearing finance within the system. But, anyway, that seems to me a sort of longer-term issue you want to look at.
Because we seem to be almost caught in a kind of series of constraints where something has to give, but nothing looks like it will. Do you think there's a very real danger that in Europe we end up splitting, that there's a northern monetary union and a southern monetary union.
Yes, that seems to me one possibility. I think for many of the countries that, though by no means all, I'm not trying to exaggerate, in the current monetary union, the only reason they are still in it is that they fear the consequences of leaving it. I'm sure there are many people who think differently, and I may well not have talked to enough people, but that's my sense of it. This fear is very, very great. And the power of the centre in the European context is immense. So I do not underestimate the likelihood that what I think of as the centre-left, centre-right consensus on how to do things will hold, and that Greece is a special case for reasons that I think are reasonably obvious, and therefore the centre will hold, nothing will give, the stagnation will, as it were, be managed, there will finally be some recovery, oil prices help, and it will continue. So I don't underestimate that possibility at all. I think it seems to be perfectly possible. But there are other possibilities, and those possibilities include the worsening economic and political crisis with an interaction between the two, as they always do, and at some point some society says, because of who they elect, whatever, we're out of this. And I'm not going to be brave enough to predict who that might be. But all to say, if the ECB's current QE doesn't work, it could either give up. Yep. By not working, I mean that it doesn't stop the move towards deflation, or it doubles or triples this. My reading of this, there is probably a point at which the German public say, enough of this.
Yeah.
And so I certainly don't see that as in any way inconceivable. The centre in Germany is unbelievably strong. Angela Merkel represents it, but she's not going to be there forever. And politics changes when people get angry enough about what is being done in their name.
Yeah. One of the more radical ideas in your book that I love, and you've come to Chartered Accountants Hall to talk at the Positive Money event about it, is the idea of stripping banks of their ability to print money. And one of the points you make is that their ability simply to create money in deposits and loan accounts kind of fueled their irresponsible lending. And again, you just said, one of your roles is to put ideas out there and as a very credible voice for people to sort of find those as almost less threatening because you say them. What do you think there is a genuine possibility that somebody might actually say, we're going to do this, and actually we're going to do not only this, we're going to use it as a tool by which we can push money into the real economy in a way that gets growth in the right place?
Well, first of all, the idea is not crazy. The economists who put this idea forward in the most rigorous way, interestingly, were the right. It's very important. This is not a left-wing proposal originally. It was the Austrians. Von Mises was dramatically opposed to fractional reserve banking, which he thought was the source of all ill. Hayek had a slightly different view. I won't go into that. And it was the Chicago School. So, and one of the people actively involved in this, a set of ideas, 100% reserve banking. You can have variants, you can have 30%. Sure. Was Irving Fisher, who certainly, despite some mistakes, the greatest American economist. So these were really serious people. Why did they think this made sense? Because having a situation which was first, which Wicksell first identified in the late 19th century in his classic work, in which essentially money is created by the credit system. So it's a byproduct of the lending of credit creating institutions, very loosely controlled by the central bank, very loosely indeed, creates an absolutely central fragility in the system, which is inescapable. And the fragility is that the money, that the asset that everybody relies on to be absolutely safe, the final reserve of purchasing power, the stuff with which you can settle any bill, that's what money is. So whatever goes wrong, you can go out and buy something with money. Well, actually, the assets on the side of this are whatever the banks have decided to create, which might be wonderful or they might be absolutely colossally bad. And if you've got the facility to create money in this way, you are going to abuse it, which is why the history of finance is the history of banking crises. There have been about 140 banking crises, major banking crises in the last 35 years. Most of them didn't affect people here because they were in the emerging world. Now they affected us too. There is almost no major country that hasn't been affected by this, directly or indirectly. Japan, the United States, the United Kingdom, and now much of the Eurozone to a greater or lesser extent, and every emerging country merchant you can think of. So this is so we've got this unbelievably fragile financial system, which has to be regulated very closely, and it has to be guaranteed by the state, because money is a fundamental attribute of the state, and allowing it to collapse is not something any government could survive. There's a reason why governments always save the banking sector, which is, if they didn't save the banking sector, they're gone. No government can survive the disappearance of its banking sector. So it's clear why this is a very, very dangerous structure. And if the entities concerned are on average leveraged 25 to 1, it doesn't take very much for people to get pretty panicky, 20, 25 to 1. That's the system. Now, could we replace this? Yes. What would be the consequences of trying to replace it? Well, it would certainly be a different world. Now, you asked the question, which I discussed. You asked the question, could I persuade anyone to try? I recognize, I'm completely realistic, that this is not going to happen anywhere soon. It may never happen. But I think so what my idea has been to try and persuade some small country with a sufficiently smashed up system to have a go at this and see what happens. And so my favorite is Iceland. And I'm in contact with some Icelandic politicians who are quite tempted by this idea. I would like to see how it would work. So the idea is to have a core monetary system, a payment system, which is separate from the credit system. Now, policing the interface is very, very difficult, and it creates all sorts of problems and challenges which we could discuss at great length. But at least this way of thinking about it identifies what is the core fragility here. The essential point is that as long as we have a banking sector like ours, it is inextricably linked to the state, inextricably controlled by and underpinned by the state. And as long as that's the case, you have to accept that finance, which is probably the core of any capitalist system you can imagine, is in a very profound way a state-run system. And the idea that it isn't is just look at Basel, just look at all the details. This is a state-run system. I mean, this staggering regulatory oversight. Now, you could say the state doesn't do a great job. I accept that. But it still is a state-run system. There is no other system, part of the market economy that is regulated in quite this way, to quite this degree. No. And that's pretty anomalous, and it ain't working well, is it?
No. Thinking about regulation, we must think about our hosts. And before we move into the audience and let somebody else have some questions. One of the things that Finance Watch advocates is very much about greater capitalisation of banks, which is obviously being discussed at the EU currently, but also a move to more local banks so that there's a sort of an understanding of the environment that their clients are operating in. You sat on the Banking Commission, the Vickers Commission. What's your view about the regulation?
Well, I think within the context, first of all, I think there are no, well, it's banal, there are no perfect solutions to the financial sector instability problem. It's inherent in it.
Yeah.
And you have a series of difficult trade-offs. I won't go into my more radical proposals. First of all, I do share the view that there's a very strong case to move towards a system with higher equity ratios. The leverage in the system is frighteningly high. And while that seems to give short-run benefits, they're quite modest. I mean, the short-run benefits are loans are a little bit cheaper. One shouldn't exaggerate that, by the way. I've discussed that in the book. The benefits, the costs of moving from a 20-to-1 leverage ratio to a 10-to-1 leverage ratio in terms of higher cost of funds are not that large. They're often exaggerated, but they do exist. They're modest, but they probably do exist. But I think doing that makes a lot of sense. And if you could do that and get rid of some of the regulation, which is sort of moderately crazy, I think that would be quite a good thing. I'm very much with Andy Haldane, who did this wonderful paper called The Dog and the Frisbee at Jackson Hole a couple of years ago, in which he basically pointed out that if you just look at the rule books we're generating, it's just impossible to imagine the banking sector can operate effectively within that context. Just make them more robust. So if you leave aside the fractional reserve, reducing leverage is part, it seems to me, of the solution if you want any sort of market-oriented system. Of course, if they continue to be part of the state, then you can just treat them as subsidiaries of the state. Now, you ask about the local thing. Here's where you're getting to the trade-offs. I believe in the idea of a diversity of banking institutions. So, and that would even be true in the fractional reserve world. Institutions will do different things. Local banks, as we know, so we've had lots of experience with local banks across Europe, and they vary in their effectiveness. The advantage is they have local knowledge and local connections. The disadvantages are they're very exposed to local economic conditions. So if there's a depression in the local region, maybe for reasons that the bank has nothing to do with, it's going to affect its entire portfolio. That was one of the reasons so many of the banks in America went down in the 30s. So we can go a long way. A huge number of them were agriculture-connected banks. They were local banks whose lending was ultimately underpinned by farming, and the farming sector was collapsed in the Great Depression. They all went down. It didn't mean that they were particularly bad banks. It just meant that was so that's the lack of diversification problem. And the other one, let's be realistic, as we've seen this, and I'm not going to mention any countries here, but local banks, small local banks, have a terrible tendency in the wrong circumstances to come under the control of local politicians. And this is not always carried out with perfect honesty and integrity. And that worries me. So while I'm perfectly happy to have smaller banks and specialized banks, I'm keener on specialized banks than local banks. I mean, that is to say, I think one of the examples is referred to in the Finance Watch paper that I looked at is Handelsbanken. That's a specialized bank, but not local. So a bank that focuses on business lending. I'm very interested in the idea of banks that specialize in business lending, but across wider regions. But I do think a world which consisted only of local banks, small local banks, is not necessarily more stable. And this fits in with one absolutely crucial point. There's an enormous discussion, particularly in America, of the too big to fail problem, and that the main form of moral hazard in the system is too big to fail. And I agree with that. Too big to fail is a problem. But if you get a very large number of smaller banks all taking on the same risk, even if they think they're not going to be bailed out, they just make mistakes. I happen to believe a core part of what goes wrong in financial crises is not perverse incentives, though they're not unimportant. It's just people all make the same mistake together because they believe a class of assets is safer than it actually turns out to be. That's a generic problem. You must have experienced this. People, whole groups of people think this asset is really, it's never gone bust before. You know, I had nothing but American friends of mine, including, and I won't even, it's embarrassing to mention them, who told me housing in America was completely safe because we've never had a general fall in house prices in the US, to which my response was, you never have it till you have it. So in this situation, let's suppose the United States, and actually it was a bit of the condition that happened in securitization, the United States had a whole host of small banks, all of whom thought that the housing was completely safe, and they all piled into housing, you'd have had the same bloody mess. So I think it is a mistake, and I'm a bit unpopular with this, to think that just having lots and lots of small banks would solve our problems. I don't think that is the case.
Questions from the audience? Do you want to put your hands up, anyone? There's a gentleman here. There's a microphone coming. If you could just tell us who you are and where you're from.
Yeah, thank you. My name is Julian Müller. I work for SOMO, a Dutch NGO. I am, first of all, immensely grateful to Martin Wolf for drawing our attention to the bigger picture, which I felt was sorely lacking during the first panel today. When you listened to it, you would have been justified to assume that, well, the whole securitization, capital markets union agenda, it's all a done deal, we like it. So all that's left to discuss is technicalities such as, do we allow tranching or not, and if so, how exactly? I feel it's necessary, coming from a civil society organization, to take a step back and ask whether the agenda, the Commission's agenda for capital markets union, of part of which is also securitization, is in fact, well, is that an agenda that we like? And I'm sure later on today, when Jonathan Hill is going to be here, he's going to say that, well, this is going to boost growth and employment and get us out of this slump. Now, Martin Wolf, so I'd like to ask you, you talked about that it would be necessary to transform incentives for investment in the private sector. And I'm sure Jonathan Hill would say, well, that's what we will do. Now, well, what do you say? Is this going to deliver in your view? Is this the sort of incentive that you feel is necessary?
I tend to feel that I'm in a sort of credo quia absurdum position, which is, what else have we got? So first of all, let me talk about where I think it might help, where I have some sympathy for securitization, some substantial sympathy, and then I will discuss why I don't think it can solve the problems, where we are now. And to do this, one has to separate out, as it were, the long-run conditions of a functioning Eurozone financial sector from the particular structural and contingent problems of a deep slump, which is what Eurozone is in aggregate, I'm afraid, in my view. If you had a financial sector in which the assets were predominantly owned, the claims were predominantly owned by relatively unleveraged entities, households and institutions which intermediate household savings without much leverage themselves, so pension funds, insurance companies, and so forth, entities of that kind. And on the other hand, you had a large stock of liabilities of a whole vast range of private borrowers, business, households, and so forth. You could, in theory, reduce very substantially the core fragility that I've already discussed, which is the one that is generated if the principal intermediary in the system is banks. Because the essence of banks is they don't have any equity. And the people who finance them know they don't have any equity. So once they start worrying about significant losses on the balance sheets of banks, they start wondering whether their money is safe. And as soon as they start wondering about that, runs start. And central banks either deal with these, central banks plus governments either deal with these or they don't. And if they don't, they start going through what are now euphemistically called resolution processes, in which a lot of creditors lose a lot of money. And in that situation, the panic, in my view, is going to get worse. I have a constant argument with one of my colleagues who's very keen on resolution strategies, and my view is they're absolutely fine if you have a small problem, and they're going to blow up in your face if you have a big one. Now, so in this context, moving towards a world in which the dominant form of intermediation is not within the banking sector, particularly highly term transformation, long-term intermediation, so intermediation that matches a structure of relatively long-term liabilities, seems to me quite desirable. Of course, we also know that securitization, by its nature, is subject to massive information problems, information asymmetries. And in the case of US subprime, we had one of the clearest examples of the Akerlof's famous lemon problem in the history of the world, as it were. They all became lemons, so the market collapsed. So there are big advantages in moving in this direction, but it's really difficult to make it work well. You have to think through the institutional information incentive problems in a securitized world very, very, very carefully. I have not looked at the Commission agenda, I've put my hands up, with a sufficient care to have any view about whether it is being done in a good way or not. I don't know. But if they moved in this direction somewhat, I wouldn't personally say this is necessarily wrong. But there's a second question which you asked, which is, would it solve the problem now? Now, this gets to the really big question about where the Eurozone is today, which is the principal, and here I'm modestly agnostic, but not really very agnostic, is the principal problem facing the private sector, particularly in the peripheral countries, quote unquote, the vulnerable countries, whatever you like, that the firms, the SMEs and so forth, can't get the credit they need, but they do have markets they want to serve. They have things they want to do. If only they could get the credit. Is it a credit-constrained world, or is it actually fundamentally that they're in stagnant economies, their customers, the households are in terrible shape, incredibly cautious, and nobody wants to spend? If it's the latter, fixing the intermediation system isn't going to do much for you. If it's the former, then it could do a lot. My own view is that at the moment, the underlying demand problem is so deep that it won't be sufficient. It might be necessary, but certainly not sufficient to fix the credit system and to get the economies really growing again. Where they have grown well, or somewhat better, like in Spain and Ireland, it's clearly been in very significant measure off the external sector, and I think that's to a significant extent a zero-sum game for the Eurozone as a whole. So the answer is, I would be in favour of the securitization done in the right way. It might help a bit, but it seems to me it has to go along with some way of fixing what seems to me clearly some very, very deep demand problems in the Eurozone, which are not going to be fixed quickly on any of the strategies now available, though obviously ECB is trying to do so.
Thank you. Any other questions? We've got a gentleman here.
Yes, good afternoon. My name is Alex Hornung. I'm here from Monetary Network Alliance. I have two questions. From Monetary Network Alliance, okay. Monitor. I have two questions. One, you spoke about growth, and you see the resources, natural resources of the Earth are depleted very soon, continuously. So we consume more than one Earth per year already now. What makes you think that we need more growth, material growth? That's one thing, first question. And second one, you said we have a overcapacity of bank credit of debt. We know we have too much debt around. Now, as a correlation, positive money, whereas we know now that money comes into circulation through debt, so we have too much deposit. If we have too much debt, we have too much deposits. It's sort of like a hot air balloon that's going up. It's always pumped up. And now I was wondering, now we're thinking about interests are close to zero. And have experience in Switzerland where the yield curve until 10 years is in negative territory and people getting loans at minus rates. So I'm wondering, And that's why my radical solution is, what do you think about putting interest rates to negative, to minus 5%, even including banknotes? Because that is my experience, practical experience, makes money run very fast. Thank you.
Well, if you had a zero growth world, or maybe even a minus growth world, one would assume that negative interest rates would go with it. So the two are obviously related. There's a relationship, the rate of growth and the rate of interest in sort of fairly standard economics. So if you move to a minus growth world, then minus interest rates would make sense. Now, let's deal with the latter part and then the former part. The latter part, could you have negative interest rates? Large, highly negative interest rates. Well, to do that, you would have to partially demonetize money. By that I mean my friend Willem Buiter, who's chief economist of Citi, has written about this many times. You basically have to take cash out of the system. So you can demonetize cash. You basically refuse to create banknotes. So you have to hold electronic money. And electronic money, national electronic money, well, it gets an interesting question of, I'm not going to get into the Bitcoin thing, it takes too long, or other electronic monies. But once you get rid of cash, you can impose more or less any interest rate you want. I mean, there's a limit. At some point, people are going to start going to barter. But at the moment, if you went to minus 5% interest rates in deposit accounts, and still people could hold cash, I assume you would quite quickly start getting lots of people go to the bank, would take out all the money, put it into banknotes, and the vault business would just explode. So there will be a large number of companies that would create huge vault systems, and depository receipts will be traded as money, which will be outside. It is a 100% reserve system. It is money, and depository receipts would then be traded as money. You wouldn't move the stuff around, and you'd have an electronic system emerging outside the government. So you would have moved to my system, but in a very, very... So you might not want that, because that would be a zero-interest world. You couldn't go below that, except for the cost of the storage and the moving of the... So there would be a little... So the assumption has usually been you can go to -1 or -2 maybe, but beyond that, the flight to cash will be unmanageable. The solution to that is to get rid of cash. Well, the alternative is to have, which is a very neat idea, is to have time-dated money. So you could have money with green notes, which you could only use as money legally in 2015, and they become blue notes or whatever. So you can do it. But did you say you are Swiss? I didn't get that. But anyway, I wasn't clear whether you said you were Swiss. Yeah. No, but it's very modestly negative, not big-time negative. Yeah, you can move to negative rates. I'm surprised the ECB hasn't gone further in that direction. It might be one of the things it does. And that would probably encourage spending. Now, you don't want to encourage spending. Then your second question is could we have growing economies at all? And this raises all sorts of questions, moral and practical, and what are the limits and so forth, which I consider to be beyond my remit in this discussion. But what is not clear to me is how you stop it. Now, in the last couple of 100 years, we've discovered this strange thing called innovation, which allows us to do more all the time with the resources we have at our disposal, and to use more resources. And it seems from the way people have responded to that, the work patterns and so forth, is though we've taken some of this incremental abundance, which is staggering, in leisure. We have taken some of it in leisure. We don't work as hard as our great-great-grandparents. We've taken most of it in more stuff. And telling people that actually they're not going to have more stuff, they're going to have less of it every year, it might not be a winning political project. Now, and since I believe in democracy, That's quite important. Now, if a Green Party got elected in major countries and wanted to do this, you could, but you'd have to accept some quite radical implications for the way you'd run your society. Because basically what you would have to do, since you wouldn't want to eliminate all the virtues of a market economy, I'm not going to discuss whether I believe in this or not, is you'd have to tax anything that starts generating incremental output. The most obvious way of doing this will be in my view, will be to tax resource use to the point at which incremental resource use stopped. Doing this in one country would be pointless, wouldn't change the world, so you'd have to do it globally. And all I can say is good luck.
And I think with that we're out of time. So would you join me in thanking Martin in the usual way?